You're watching Business Incorporated live on Channels Television. Coming up, South Africa's mineral production achieved record values in 2021, exceeding R1 trillion. Egypt's net foreign reserves increased to $37.1 billion in April. And the European Investment Bank formally agrees to provide 27 million euros of new long-term financing to Cameroon. Great to have you join us on the program. I'm Ladi Williams. Let's take a look at how your money is performing at intraday. Starting in Africa, trading sentiments were mostly negative, except in Nigeria, where the equities market appears to be in a world of its own. The NGX continued its upward trend despite the global rout, and Nigeria's main index was up by 0.34%, hitting another milestone as it crossed the 51,000 level, while South Africa's index dropped by almost 1%. Elsewhere, Egypt's equities market stumbled. Its index was down 1.34%, while the Nairobi Stock Exchange ended Friday's trading session also in negative territory. And now to the Middle East, where major equities were also trading with mostly negative sentiments at intraday. That's the markets we actually track in the Middle East. The Abu Dhabi and Dubai index were both down by 0.68 and 1.97% each. Still within the region, Saudi Arabia's traded slightly higher by 0.06%, while the Qatari index fell by 0.31%, all at intraday. And now heading to Europe, it's all about Russian oil and gas boycott, and Europe seems to be finding it hard to reach a deal. Well, we have Chris Kober right there in Berlin. Great to have you, Chris. Well, the EU leaders want but have been failing to strike a deal so far. What's the holdup?
The sticking point is how to secure oil supplies to landlocked Hungary, Slovakia, and the Czech Republic, which all depend heavily on Russian crude delivered via Soviet-era pipelines and who face a challenge to secure alternative sources. Now, the package suggested last week by the European Commission would have seen most EU members halting oil imports from Russia by the end of the year to punish Moscow for invading Ukraine. But several member states, most vocally Hungary, demanded exemptions from the ban and/or support to help them escape their long-standing dependence on a single pipeline for Russian crude. Hungarian Prime Minister Viktor Orban has declared the package as presented crossed a, quote, red line for Hungary, but diplomats in Brussels insist the technical negotiations are not blocked. Hungary, Slovakia, and the Czech Republic have been offered permission to continue importing Russian oil until the end of 2024, but they also want help securing new sources of oil and retooling their refineries. Now, with European diplomats so far failing to reach an agreement, the EU foreign policy chief Josep Borrell is now likely to call a meeting of foreign ministers this week. Any decision on sanctions would have to be approved unanimously by member state governments.
All right, so much for the EU leaders to decide that. But in a bid to lower CO2 emissions, Germany's transport minister apparently plans to large incentives for the buyers of electric cars. Tell us about this.
Indeed, there seem to be plans of massive subsidies that the Transport Ministry apparently has been working on, increasing already existing incentives and extending them. According to German news reports, the ministry has been asking numerous economic research institutions to evaluate what it calls an immediate climate protection program. Now, in it, the government's current premiums, which is paying to people purchasing electric cars, would be sharply increased. Buyers of a vehicle worth around $40,000 could get more than a quarter of that reimbursed through incentives. Now, that would mean roughly doubling the existing sum. Also, there's a $3,200 subsidy which manufacturers are currently paying. And starting at the second half of next year, customers will have to scrap an at least 11-year-old car with a combustion engine to receive the full benefits. Now, the programs are set to cost up to 73 billion euros, or around $77 billion, and are meant to run until 2027, start decreasing by in 2025. And that could become a bone of contention within Germany's three-party coalition government, because in their coalition agreement, all sides agreed on ending all incentives for car buyers by 2025. That's why there's also much less money in the country's budget earmarked for these programs.
Quite interesting incentives there, Chris. But, you know, global stocks fell on Friday despite the solid jobs data from the U.S. How's this week's trading kicking off?
Somewhat more composed, but a real feeling of optimism is still missing. Chinese economic data sparked concern among investors this morning, with Chinese export growth tumbling last month as global demand weakened. That is adding to the pressure on the world's second largest economy after Shanghai and other industrial cities were shut down to fight virus outbreaks. Exports rose 3.7% over a year earlier to around $274 billion, down sharply from March's 15.7% growth, as customs data showed. Now, demand for Chinese exports is under pressure from high inflation and interest rate hikes in the United States and other major markets, and consumer uncertainty about the economic outlook and job prospects. And this sort of number is not really useful to up the mood on financial markets. The DAX in Frankfurt pretty much unchanged compared to where it closed on Friday. Other markets in Germany and Europe feeling the pressure and trading slightly lighter in the early parts of today's trading session.
Well, I guess the sell-off still continue today. Well, we'll see how the week plays out. Thank you so much. That was Chris Kober right there in Berlin. Well, let's move on to the UK now. We have Juliana standing by right there in the UK. Great to have you, Juliana. Well, Britain's biggest bank is said to be caught in the US-China crossfire in the midst of a request for HSBC breakup. What are you hearing about this, Juliana?
Good afternoon, Laddie. Yeah, this is a pretty interesting story, which was first broke publicly by the Sunday Times last weekend. And I think the argument over whether or not HSBC should be broken up into different divisions is a decades-old debate, but it has been reignited by its biggest shareholder, which happens to be a Chinese firm. They are an insurer called Ping An. They own 9% of the market capitalization of HSBC, which is worth a whopping $9 billion. And now they have raised concerns about the geopolitical tensions surrounding HSBC. And we know that over the years, HSBC and bosses have been embroiled into scandals because they seemingly backed China rather than backing those in the West. Of course, it is headquartered here in the UK. And Ping An have suggested that rather than being caught up in this geopolitical tussle that has, of course, been made worse by the invasion of Ukraine by Russia, it should be separate. And I think for bosses, it's a really difficult argument to try and defend against, because if you look at HSBC's pre-tax profits last year, it was £18.8 billion. 13.8 billion of that profit was generated in Asia. And every time we do get the trading update from HSBC, they are always saying that they are shifting their strategy towards that region. So Ping An is saying, why not just break it up? It is going to be a very complex divorce if it does happen. We know that HSBC does trade in London. It also trades in Hong Kong. They also trade in 63 countries across the world, not on the stock market, but certainly in terms of employee count. They've got over 230,000 employees. 20,000 of them work just a stone's throw away from here in Canary Wharf. So what does happen? There are lots of concerns, but perhaps because of the geopolitical tensions, it could be much better for the bank in the long term if it were to split. But I think there are some concerns about what would happen to HSBC in the UK. Is it big enough? It does appear as if it is. At the moment, I believe the market capitalisation in the UK blue chip index at the moment is just above £3 billion. It would kind of put it on par with NatWest, Lloyds, but then we know that banks' profitability over the past few years has been cut short because of impairment payments due to the pandemic. Again, the war in Ukraine isn't making things any better, but it is going to run this debate. It has been going on for decades, but now HSBC have brought in the likes of Goldman Sachs to help them advise. And of course, when you are owning the large majority of shares like Ping An do, and they are a China-based, it does make things very, very difficult for the London-based bosses of HSBC.
Quite interesting times for investment banks, you know, with geopolitical tension. But moving on, our plans to forcibly move millions of people off legacy benefits and, you know, onto the universal credit begin today. But this is not going down well with everyone.
It's not going down well with charity groups. I believe about 20 have written an open letter to the Chancellor Rishi Sunak asking them not to do it, but it's happening today. I think a lot of people who may or may not be familiar with the UK's welfare system, or benefit system as it's called here, may not realise that there are two systems that are in place. You've got the old system where people get job seekers allowance, income support, housing benefit, disability allowance, and then there is a new system that has been put in place by the Conservative government called universal credit. So rather than getting each individual amount of money every week or every 2 weeks as you're entitled in this country, it's all going to be a part of this one system that when it was first launched a couple of years ago was marred with criticisms and failures. It was such a huge system that it ineffectively shut down in the first couple of days. Now, people who were on those benefits were already being moved over before the pandemic hit, government resources went elsewhere, so people were able to stick within the old style benefit system. Now that we seem to have gotten over the worst of coronavirus, the government are enforcing this transition. Now, it starts from today. People on those old style benefits, I believe there are about 2.8 million people that are still receiving those old style benefits. They have 3 months to make sure they make all those changes. But of course, within those millions of people, there are some people that do find it difficult to engage with technology, do find it really difficult to engage with the bureaucratic system that is the HMRC. And so charities are worried that this is going to be a huge issue, particularly at a time, of course, when the UK is going through its cost of living crisis. Most people who are in, a pretty dire need are looking at how they can heat their homes and, put their gas cooker on, not necessarily deal with these really long bureaucratic documents. So it is a concern, but the government says it's going ahead, and they've got 2.8 million people to shift within the next 3 months.
Quite interesting, even as the squeeze, continues right there in the UK. But how are the markets looking? I know it's been a tough market since last week, the bloodbath with Bitcoin and most markets. How's it looking right there in the UK?
Well, the bloodbath continues. Red is the colour of the square mile today. It started off in the red, but those losses have deepened as we get into intraday. The FTSE All-Share is currently down by 1.91%. The FTSE 100 down too by 1.92%. And the FTSE 250, the domestic market, that's down by 2.29%. In the currencies market, the British pound is up against the US dollar by 0.02%, also up against the euro by 0.06%, and up against the Japanese yen too by 0.46%. Worth mentioning, Laddie, you mentioned last week that there were these losses, and that was kind of led by that very gloomy, unpalatable Bank of England forecast that the UK could go into recession by the end of the year. That statement was echoed by the EY Item Club, who have also downgraded the outlook for the UK economy this year. So it's not a great reading, as we are going to the reopening of Parliament tomorrow. We're expecting a Queen's speech because of those local elections. So the Prime Minister is going to set out his agenda, and I'm sure economics and the squeeze is going to be top billing.
Quite interesting. Well, I guess these markets need some kind of relief. Hopefully that comes soon. Thank you so much, Juliana, for the update.
Thank you.
All right, now we'll take a break now. When we come back, more stories on the African continent. Do stay with us. This is Business Incorporated. Welcome back now to our next conversation. The European Union is planning to turn to Africa to help wean itself off Russian natural gas. Seeing countries in Western Africa like Nigeria, Senegal, and Angola in particular have largely untapped potential for liquefied natural gas. But how would Africa step up to this? We have joining us Femi Adeyemo, CEO, Energy, Oil and Gas. Great to have you on the program.
Good afternoon. Thank you for having me.
Great. Well, yeah, so paint a picture of the kind of investment needed to make this, reality of getting African gas to Europe.
In recent times, there had been a lot of information around, it's Nigerian time to be able to send gas to Europe. But I think that if we look at the investment that is required, it's not a child's play. We're talking about $5 million for every kilometer of gas that needs to be piped. And if you look at the distance that has to be covered, we're talking of about close to 7,000 kilometers. However, the good news is we don't have to pipe from Warri or from Port Harcourt to Europe. We can actually connect, to the gas pipelines that are already existing in North Africa, especially in Algeria. And there are some initiatives already that the MOU had been signed, but that has been for some time now. So indeed, when you talk about investment, we're looking at about $5 million for every kilometer, and for us to connect to the closest gas pipeline to get Nigerian gas to Europe, we're looking at about 4,400 kilometers. So we're talking about excess of $20 billion for that to happen.
Right, quite a huge sum there. But looking at investment and where Nigeria is, right now, we also have the issues of securing these pipelines. What are the risks here?
The risk is there for everyone to see, right? Because even locally, we are all aware of instances where we've had leakages or pipeline vandalism locally. So if you're then looking at 4,400 thereabouts kilometers of pipeline from Warri to Aserimel in Algeria, definitely there will be concerns around security. And that's one of the things that has stalled the project, because there is the Trans-Saharan gas pipeline, or otherwise called Nigel, that the Nigerian government had signed MOU with the Algerian government since the early 2000s. But here we are in 2022, it's still not, it's still in the prospecting stage. At some point, it stalled, again, because of security challenges. So indeed, it's not something that we can wake up tomorrow and say, you know what, we now have a gas pipeline from Warri to Europe, or even to Algeria, like I mentioned. So indeed, the challenge is real. It is happening locally. And of course, for it to happen, for us to be able to have gas pipe from Warri to Algeria, of course, to link to the pipeline that already is in existence to Europe, there has to be intentionality, not only from the Nigerian government, from all the other countries. It passed through Niger to Algeria, and then before it will get to Europe. So there has to be a lot of intentionality and willpower on the board, from the government side for it to happen, given the investment that is.
And looking at the oil and gas, value chain, what do the players there also, what do they have to do, to make this a reality?
As far as I'm aware, most of the initiative that is far ahead is still, the one I mentioned, the Niger, which is likely an MOU between NNPC and Sonatrach. Sonatrach is the Algerian National Oil and Gas Company, similar to our NNPC. So that's largely where the conversation is still on. Are we going to see private sector play in that value chain? I'm not sure, given the quantum of investment that is required. Of course, we have, our billionaire, the African richest man, Aliko, spending similar amounts. In the factory that is at the Lekki Free Trade Zone area. So, indeed, it's not impossible that we can have a private sector player participate in this, but of course that will require a lot of effort and some sort of backing from the government. And I'm talking of not only the Nigerian government, but the European government, because if Nigeria is really critical to the German or European strategy on the repowered EU model, it is important that there has to be big play here, and no private sector player will invest such amount given the security challenges along Niger to Algeria. No private sector player will want to
quite a
get
huge
into such
investment there.
Or significant.
Yes. Okay, but before I let you go now, which African countries do you think will lead? When it comes to meeting Europe's gas demand?
So I think geography had already placed countries like Algeria in a good position because of the proximity to Europe. They already have gas pipeline. There is the Maghreb-Europe gas pipeline. There is Medgas. So those are already there. In their own instance, the problem is a function of capacity, not infrastructure. But unfortunately, in our own case, it's a function of infrastructure, not capacity. So I think that the North African countries, given that infrastructure is already available, they are in a pole position to be able to bridge the gap. And that's why also new initiatives like renewable energy-based hydrogen and coal might come into play, because Europe is not only looking at pipe gas, they're also looking at other alternatives that can get them out of this crisis.
Right. So I guess some African countries already have a head start because of geographical location. All right, thank you so much, Femi Adeyemo, CEO, Energy, Oil and Gas. It was great having you on the program.
Thank you for having me.
Thank you. All right, I'm moving on to South Africa's mineral production achieved record values in 2021, exceeding R1 trillion for the first time, buoyed by strong commodity prices and giving the domestic economy a vital injection of higher taxes, wages, and increased employment. According to the industry body, the Minerals Council, South Africa's Facts and Figures 2021, the performance of the mining industry after 2 years of disruptions caused by COVID-19 pandemic played a critical role in stabilizing South Africa's economy, which had slowed under lockdown conditions. And the European Investment Bank has formally agreed to provide 27 million euros of new long-term financing to support investment by entrepreneurs and businesses across Cameroon and strengthen economic resilience to the COVID-19 pandemic. The streamlined business financing represents the largest ever EIB support for private sector investment in Cameroon, and as part of the EIB's increased engagement with financial partners across Africa to strengthen economic resilience to the pandemic. And Egypt's net foreign reserves increased slightly to around $37.123 billion in April from $37 billion at the end of March. According to the Egypt Central Bank, as a consequence of continuing challenges, particularly the Russian war in Ukraine, as well as increasing food and energy prices, country's NIRS's March dropped for the first time since May 2020 by about $4 billion, down from $40.9 billion recorded in February prior to the war breaking out. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Bye for now.